Hello my friends, Jeff, Tax Rescue CPA. Are you a new real estate agent or have you been an agent for years? Does the thought of taxes keep you up at night? Well, have no fear. I'm here to go over everything with you. We're going to talk about income, expenses, specific kind of expenses, taxes, estimated payments. In fact, here's an outline of what we're going to go over. We'll start with the income, then we'll look at general expenses, and then we'll dig into some specifics about expenses like home office, meals and entertainment, auto expense, and gifts. And then we'll talk about the taxes that you're going to face and also how to make estimated payments and when to get the money in to keep yourself covered. Now, here's our basic starting point. And this is the equation you have to keep in mind in all of this and why we're doing this is you start with income at the top, you subtract your expenses, and this gives you net profit or taxable income. And that's the number we want to make as small as legally possible. I'm not talking about reducing how much you earn. I'm talking about reducing how much you pay taxes on, the taxable income portion. That's what we need to focus on and minimize to the fullest extent or the smallest extent legally possible. Okay? And this tax bite is something that can really affect your bottom line as far as feeling like you're productive in this real estate activity, because with self-employment taxes, federal and state taxes, it can really take a bite out of your commissions. Now, we're going to talk about specific tax details, but let me warn you right now, we're not going to dive deep into the tax code. Yeah, can I get an amen? Yeah, that's for another video. Here we're going to talk about it at a level that you need to understand for how to make it work for you day to day when you're going through selling that real estate. The focus is to maximize your deductions, and you can't maximize your deductions if you don't know what's deductible, and that's what we're going to learn today. So let's dive right in, starting with income. Well, let's explain first about how you're going to get paid as a real estate agent. Being a real estate agent is different than having a regular W-2 job where you get a W-2 at the end of the year. You're going to be considered self-employed and you're going to earn commissions rather than wages. And these commissions are going to be reported to you on Form 1099 NEC. Okay? Let's take a look, just so we have a good starting point, at what Form 1099 NEC looks like. This is the form you'll receive. You're not going to receive a W-2 form. In addition to providing you this form, your broker is going to send this exact information to the IRS. One thing to note about your reported income, what gets reported to the IRS, is it's reported on a cash basis, meaning that the money that you receive in hand during the calendar year is what gets reported. So for example, if you close a deal at the end of December, but your broker has a policy of paying commissions the following, let's say the end of the week on the following Friday, and that falls into January, the commission on that deal will be reported to you on that subsequent year, on the January year. So even though the deal closed at the end of the prior year, you're going to pay taxes on that money at the beginning, or you're going to on the next year. Okay? That's really the only tricky part about the income. That the details of your income is something you work out with your broker as far as what your percentage is and how it's paid and when. For the purposes of this tax planning and tax strategizing video, your income is what it is. It's pretty straightforward. Let's start looking at expenses. That's where the fun is. So expenses. Well, what expenses are deductible? Who decides this, what's deductible or not? Well, to tell you the truth, there's no definitive list. You can't Google something that says, give me a list of all the deductible business expenses. Well, why not? Well, the reason is that the tax code defines a deductible business expense, or business expenses are those that are ordinary and necessary in your business. Those that can be connected to or are related to the production of income. Just as a little side note, if you ever get audited, one of the things that the IRS will audit an expense about is saying, okay, we know you spent this money. We don't argue that this money was spent. The issue here is whether it's a business expense or not. And you actually have to prove that it's related to the generation of income. Because if you're generating $10, the IRS will let you deduct $2 against that $10 worth of income all day long. Okay, so let's talk about these two terms, ordinary and necessary. Well, ordinary, that means in your business, what's ordinary? For example, let's say a retail business. A retail business is going to have a different set of ordinary expenses than you will in selling real estate. Okay? And necessary, this term goes back to what I just said about income. The expense is necessary for the production of income. And being able to tie those together is what the IRS is always looking for. So how do you figure out if an expense is deductible or not? Well, I've created this flow chart to kind of help you go through it. It's a kind of a quick and dirty flow chart, but it at least gives you an idea of how to think about the money that you're spending while you are producing real estate income. So let's take a look at this. So the first question you ask yourself is, am I buying this item solely because I'm in business? Solely because I am trying to sell real estate? And if the answer is yes, the only reason I'm spending this money is because I'm trying to sell real estate, then it's probably deductible. Track it, okay? If your answer is no, and you say, no, I'm not buying this solely because I'm in business, then you gotta ask yourself, does the expense contain a business portion? Is part of it, are you spending more, or is part of what you're spending being used for business? And if you can say yes, then it may be partially deductible. Again, track it. But if you get to the no side over here on the bottom right, and you're not buying it solely for business, and it doesn't have a business portion to it, you're probably not going to be able to deduct it. Okay, so let's look at some specific examples to get a little better idea of what we're talking about on this flow chart and how to apply it to your spending. Okay, so for example, if you've just become a real estate agent, you're going to be using your computer, a laptop, a lot of tech stuff. This is going to be deductible. Though it may not be completely deductible, you may have to take a proration of some of these expenses because there is a personal nature to these expenses. Cell phone. Now, cell phone, pretty much at this point, you're not going to have a hard time making an argument that your cell phone expense is deductible. Next, tax prep expense. Okay, now this may seem a little self-serving, but think about it. Before you were in business and you had to prepare your taxes, you paid a fee to get it prepared. You couldn't deduct that. If you go way back in the olden days, if you're old enough to remember that, that's another thing. But you can't deduct tax prep fee as a personal deduction anymore. But you can deduct it if part of your tax preparation is for your business. So this now becomes deductible. What about clothing? Well, this is one I get a lot. Let's put that one on pause here a second. You see it's over in the not deductible column. Let's talk about that. And then boat. You've got it as partially deductible, Jeff. What are you talking about? Okay. So I kind of teased you a little bit with the clothing and the boat. Let's talk about the clothing. Well, I get this a lot from real estate agents. Here's the argument. Well, Jeff, I have to wear nice clothes when I sell real estate because I have to look nice. So these clothes that I buy to look nice, they should be deductible, right? Ain't gonna happen. The reality is that it's specifically stated in the tax code that if the clothes you buy or the clothes we're talking about are suitable to wear outside of the work environment, then they are not deductible. So if you were to buy an ordinary suit, an ordinary dress, an ordinary pair of shoes, they would not be deductible. But as a little caveat, if you were to buy what would start to fall into the category of uniform, now all of a sudden it becomes deductible. So that's the line. Ordinary clothing, no matter how fancy or how much you think it's especially needed for your job, it's not deductible. But once you create specific clothing that's really not suitable for being worn outside of the work environment, that becomes deductible. Okay, what about a boat? Are you kidding me, Jeff? I can deduct my boat? Well, you'll see this a little more when we get into auto expenses, but just like you can deduct your automobile expenses when you're using them in the pursuit of real estate income, you can do the same thing with your boat. Think lakefront property. You take a client out on your boat across the lake to show them a piece of property, because the best side of that property is the lake, right? That's where the lakeside, that's where the nice part of the house looks. So you take them to show them the property from the lake, and you're extolling the virtues of being right on the lake and how wonderful that property is. That use of your boat can be deducted. You need to keep good track of it, and this is one of those that historically the IRS has applied a stern eye toward. So be sure that in these kinds of very specific, very one-off, that you've got both specific details that support the dollar amount that you are deducting, and secondly, you've got that necessary component. Remember we talked about necessary? Make sure you've got some irrefutable evidence that this expenditure of using your boat to show the client resulted in income. This could be as simple as just showing the commissions and the fact that they're a lakefront property. If you showed, this amount of money I earned a commission on was on this house, and the picture that's on the lake, you're golden. Okay, that's the trick on some of those. And obviously, there could be a lot of other ones. These are just examples that I'm coming up with off the top of my head. But as you have other things that come up in your specific pursuit, keep in mind how you could deduct those and how you could show that they are necessary. Now, let's talk about record keeping. There are really two different levels of detail you have to keep. The IRS has broken up expenses really into two different groups, one called general record keeping requirements and specific record keeping requirements. And the difference is basically that the general expenses just require a reasonable level of record keeping, but the specifics have higher requirements that are specific to the nature of the expense. So let's jump into those now and talk about the general expenses. Basically, if it's not specified as a specific bookkeeping requirement, then it's general, it's the default position. So some examples of these general expenses would be advertising, continued education, cell phone, dues and subscriptions, furniture and equipment, insurance, licenses, office supplies, postage, printing, seminars, all of those kind of things, okay? And there's plenty more, but that's just not that quick, but that's a quick sample of them. So what I recommend at this point is that for most small businesses, what you need to do, and the best route to do this, is to get a separate checking account. Get a business checking account. It doesn't necessarily have to be a business checking account as far as your bank is concerned, but you want a separate checking account that you use only for business items, because this will make it much easier for you to track your expenses when tax time comes, or when you want to figure out, well, what should I make for estimated payments? How much am I going to be taxed on? You can also add to that a business credit card. If you're maybe not as much of a debit card or you like a credit card, get a separate card. By separating your personal and your business financial life, it's going to make record keeping much easier, and you're going to get much better results when tax time comes around, okay? The thing of it is that right now, hopefully you're not faced with doing your tax return at this very moment, but think about how you're going to keep track of it and how you're going to come up with the numbers you need at the end of the year ahead of time, because recreating and going over all of a year's worth of expenses and income at the end of the year can be a little daunting. And what will happen is you'll go on one or two sides. Either you'll start estimating way too high, get yourself into trouble, or you'll estimate way too low and you'll leave a lot of money on the table, which is the whole point of this video, is not to do that. Okay, let's jump into specific expenses. The first one I want to talk about is home office. Now, this is one that you've heard a lot about. It's always talked about how you save a lot on your taxes and you have a home office. There are some things you need to be aware of with the home office. The first thing, just right off the bat, is there's two big benefits. One is that you will save taxes directly by the expense you deduct for the home office, but you're going to see in a little bit. The second reason is how it can affect your auto mileage deductibility. Okay, we'll leave that one for a little bit now, but let's talk about in general, what is a home office? What is this all about? A home office is a separate space in your home that's used regularly and exclusively for your business. And this can be the hard one. Sometimes the exclusive use criteria is what really gets people, because it's in your home and it's there and you use it for something else besides business. And technically that's going to exclude the whole thing from being deductible. It has to be used exclusively. Okay? So When you have this space in your home, what do you need to keep track of in order to have the information you need at tax time and be able to deduct it to its fullest extent? First thing is, you need to know how big the house is, the square footage of your entire house. Then you need the square footage of the office space. Now, it doesn't have to be a closed room, but it needs to be a definable space that you can point to and show and say, this is the space, here's my measuring tape, that is my home office. And then the third thing, obviously, are the household expenses. What are the costs for the whole house that you incur, whether it's rent, mortgage, interest, property taxes, utilities, repairs and maintenance, even yard maintenance, these kinds of things. And then sometimes there's specific expenses. Most of these expenses get spread out, or you take a portion of, because you allocate it on that ratio between the entire house and your office portion. But sometimes you can have, just to keep track of this in your mind when you're going through these things, sometimes you can have repairs that are specific to your office. Like, for example, if you did have a room that you set aside for this work and you painted the room, that expense of painting the room would be 100% deductible as your home office, okay? I'm getting too deep into the tax code on this, but remember, we want to be able to deduct the actual expenses of the home office. That's the first reason. And the second reason is because we can get more deductible miles if we have a home office. All right, what's the next specific expense that we need to keep track of? The record keeping requirement is a little bit higher. Well, this is a fun one, meals and entertainment. Okay, and we're gonna focus mainly on the meals portion of this. Entertainment follows basically the same rules, but meals is something that is just far more common in this industry. And these can really be a significant portion in an expense, deductible expense for a real estate agent. And why should you claim it? Why should you go through all this hassle? Well, you're gonna eat anyway. Why not make it deductible? Why not make it a tax benefit to you to eat? Well, let's talk about what criteria it has to meet so you can deduct it. The first thing to keep in mind with meals is that even with all the record keeping, everything's spot on and you've got it all laid out, it's only 50% deductible. So know that you're gonna lose half of this deduction from the get-go. That's just how the code works. Now, how do you make a meal deductible? This is the key, and this gets a little tricky, so let me try to spell it out for you logically. You have to eat with a purpose. I have to eat with a purpose. Well, I usually do, Jeff, I'm hungry. That's my purpose. No, you need some other kind of purpose. So there are two different purposes that qualify and make meals deductible. One is that the meal and entertainment is related to business. Okay, it can be related to business that occurs before the meal. It can have business during the meal, or there can be related business that occurs immediately after the meal. So you've got to have that meal somewhere either next to the business that occurs or the business is occurring at the meal. Okay, so let me just talk about what does this mean in an example. The one at the meal is pretty straightforward. And this your typical example would be you meet a client for lunch at the restaurant, you talk about what they're looking for or what they want to sell, their listing. You have lunch, you discuss business, it's good. The before and after work like this, let's say you've got a property that you want to show the client and you get in the car and you drive to this property, it's a ways off, and then you look at the property and you go, well, we got another property and it's way over on the other side of town, but I'm hungry. So then you stop and you eat. If you then eat in between, like immediately following that business activity of showing the property, you don't have to prove that you discussed business at the meal. You can talk about baseball. The meal itself doesn't have to have business involved with it because it occurred right next to a business activity. Okay, and then the same on the after side. If you met with the client, you initially went and got them and you ate a meal and then you went and did business right after, that would qualify too. So, and this all comes down to kind of semantics of how you prove the business portion and what business occurred that made it deductible. That's the first way to get business deduction out of a meal. What's the second one? Well, the second one is that you can deduct meals that you eat while traveling. Traveling. How do we define that? I gotta travel to the restaurant to get the meal. Does that count, Jeff? No, doesn't count. So, traveling must meet two criteria, okay? First, you must travel away from your tax home. Okay, what's a tax home, Jeff? Well, a tax home is where you live and mainly conduct business. That doesn't mean your physical home. It means where you reside and normally transact business. And this can be different geographical size for different people, depending on the size of the metropolitan area that they live in, big or small. But that's where your tax home is. So first, you've got to leave your tax home. Okay, second is that your travel must include sleep or a rest period in between the business or during the travel, okay? So if you travel and you define it as out of your tax home, but then during the day, but then you're home that night from that travel, it doesn't meet the criteria of making meals deductible. So, but if you travel and spend the night or a rest period, I always think rest period more like a truck driver sleeping in his truck, but overnight's a little easier to define if you get a hotel or otherwise sleep somewhere else. Now all of a sudden you're out of your tax home and it has a rest period. And of course this travel has to have a business purpose, that's just assumed. But the travel has to be outside your tax home and have a rest period. And then all of the meals that you eat during that trip are deductible, regardless of whether you're having a meal with somebody else or whether you're conducting business at the meal. The point that it's during the travel makes it deductible. Those are the two criteria. Again, whether it has a business purpose or it's traveling is the purpose to make it deductible. So what do you need to keep track of? Remember, we got a higher level of record keeping for these specific expenses. What do you need to keep track of? Well, the business purpose. That's what we just talked about. That's the first one. Why is this business? Second one is who is involved. Again, if it's traveling, it may not have a who, but if it's not traveling and you're conducting business, then who did you conduct business with? You need to know the place that the meal or entertainment occurred. You need the overall cost, including the tip of the meal. You need to know when, a date, and you need to keep track of what was purchased, okay? Usually some receipts can take care of this pretty quick, short order. Keep track of them, record them some way, have this so you're audit proof. All right, let's go to another specific expense. This is the big one. Dun, 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 dun. Auto expense. This is the best part. For real estate agents, most of the time, this is going to be your biggest tax deductible expense. You're out there in the car driving around, taking people places, looking at different things, getting stuff done. You're not just sitting at your home office all day. For the most part, there are some agents, I'm sure somewhere in the country where auto usage isn't a requirement, it isn't part of the deal, but let's just assume it is because for most people it is. Let's talk about that. So what you have to understand is what's deductible, and you have to be able to define the difference between commuting and business miles. And when you don't have a home office, that first trip from your home, when you leave your home to wherever your first business stop is, isn't deductible because it's considered commuting. And that's why having a home office, it can save you a lot because now all of a sudden you're leaving your office from one place of business to another place of business to wherever you're going on your first stop in the day, and that becomes deductible. That mileage is deductible. The other thing about a home office that really works out well for agents is most agents don't have a dedicated space in their broker's office. They may have, some float desks they can land at once in a while, but they don't have a dedicated space. Because if you have a dedicated space in an office, you can't also have a home office. It should be double dipping. But most agents don't. They don't have a dedicated place to land. They just work, out of their car, out of their cell phone, whatever. So that's why having a home office can be so helpful. How do you deduct mileage? Well, this gets a little tricky because there are two ways. And while probably after your first year, or if you've been doing this for a few years, you probably already figured out which one's the most beneficial to you. But that first year can be a little confusing as to which way to go. So I'm going to explain both of them, and then you can figure out which one is best for you. The beauty of auto expense deduction is, like I said, the IRS lets you use one of two different methods, and you get to take the one that gives you the bigger deduction. It's the wonderful method here that's used for determining auto expense deduction. So let's talk about the two, but before we do, I want to make a very important point here that either of the methods, you've got to keep track of your business miles versus your personal miles, or you can keep track of your total miles and your business miles, but you have to have those two figures for either or both. Either one you use, you got to have those numbers. So track your mileage, okay? So the first one we're going to talk about is the standard mileage rate, and that's where you simply take your business miles and you multiply it by the rate set by the IRS for that specific year. Here, let's look at a chart here, recent history of the IRS's standard mileage rates. As you can see, this rate gets adjusted every year, sometimes twice a year. So the nice thing about this is that you know it's keeping up with the actual expenses or the current expenses of operating an automobile. It's standard, you know, it's an average, if you will. And this rate includes everything. So taking into consideration this rate is, you know, your gas, your maintenance, your insurance, the depreciation on the car, everything. The only thing that's not is interest, loan interest. If you have a loan, you can take the standard mileage rate and add your auto loan interest to it. But that's for details for your accountant to figure out. The other thing to keep in mind about the standard mileage rate is that it tends to work best for vehicles that are on the less expensive side of the spectrum. As you get more expensive vehicles, you're going to find that the actual expense method will give you a better result or more deductions. Okay, so let's talk about that. Now, the actual expenses tracking part, you've got to really get your head around this because you've got to think like an accountant and track everything. You need to track fuel. You need to track maintenance. You need to track insurance. You need to track, tolls, parking, everything that's related to your car that can all be grouped in and have the ratio of business versus personal applied to it to get your deductions. Again, both methods are going to require you to keep track of your mileage. Have I said that enough? Is that point coming through? It's really a big deal, and it'll make tax time much more comfortable. I got this story. I'll tell you this story, okay? This is great. This goes back a few years, but I had a real estate agent. Okay, he bought a new car. He's got this car. I say, okay, Bob. That wasn't his name, but we'll just call him Bob. Okay, Bob, how many miles did you drive for business? Oh, it's a big year. 20,000 miles. Okay, and how many were you total? I was like 23,000. Most of them were business, Jeff. Okay, 20,000, 23. Year 2 comes along. That's the same thing, Bob. Okay, year 3, same thing. 20,000, 15, 22,000, something like that. We get to year 4, and Bob asked me, he goes, Jeff, I got this car, and I'm curious, how many business miles since I've had this car have I deducted? And I add them up and it says, let's say it says 78,000. You've deducted 78,000 business miles on this car so far, Bob. And he goes, oh, well, that's kind of a problem because the car only has 63,000 miles on it. So he had gotten a little carried away with his business mileage calculation, and it actually exceeded the actual miles of the car during the time that he owned it. So we had to take care and adjust that a little bit and get the car caught up to his tax deduction. So that's the thing to keep in mind. Now, how can we make this easier? Okay, tracking miles is tedious and subject to what? Forgetting? Well, technology. Use an app. Okay, I know you've probably been thinking this since I first started talking about tracking your mileage, but use an app. Here's a very popular one that's out there. Now, there are others out there. If you find one you like better, by all means use that. Use whichever one you're comfortable with and works for you. Now, you could also kick it old school if you're of that nature and use a written log. I still see logs like this for sale and people are using them. Bottom line is track your mileage. Whatever method works for you, get it done and track it because it's going to make a huge difference at tax time. And again, don't forget auto loan interest. Even if you deduct standard mileage, the auto loan interest is still deductible. It can be added on top to the mileage rate. All right, last section of specific expenses, and that one falls to gifts. Now you may be thinking, Jeff, gifts, that doesn't sound like a big deal. Well, it may be because as a real estate agent, referrals are a wonderful thing. And there's no better time to ask for a referral than when you're handing somebody a gift. Here you go, how about a referral, okay? So what do we need to know about gifts and keeping the deductible? This is kind of a downer. And that is that the big thing to keep in mind is that the IRS only allows $25 per gift to be deductible. So per gift per client. So if you're buying a $40 gift for a client, for one particular client, only $25 of that $40 expense is deductible. And these are kind of like anything else of the specific ones, is you need to keep track of the total cost, the date you gave the gift, the description of the item that was given, the purpose, why you gave this gift, and who received the gift, the recipient of the gift. Those are the record keeping requirements for gifts. But keep that in the back of your head, because it will come up and you'll say, you know what, I want to buy a gift for this client. It was really nice working with them, and I'd love to have their friends because they're probably like them, and I made a lot of money. So they give them a gift. Well, keep in mind what's deductible and what's not deductible. By all means, if you want to buy them a gift that's more expensive than $25, go for it. But no, you can only deduct $25 of that gift, okay? Now, jump into taxes. This is where we kind of get to the payoff, if you will. Well, you're thinking, taxes, Jeff, that's not a payoff. Well, it is if we've worked our rear ends off in order to maximize our expenses to reduce our taxable income. Remember our equation? Income minus expenses equals net profit. And the net profit is what gets taxed. Now, what taxes are you gonna be paying? What taxes are gonna be applied to this income, I guess would be another way to put it. Well, there's three really, maybe just two. But the first one is self-employment tax. And this is the biggie, especially if you haven't been self-employed before, is that this is Social Security and Medicare. When you're a W-2 employee, your employer pays half of this. And you pay the other half deducted from your paycheck every time you get paid. So you never really see this one or feel it. But when you're self-employed, you're gonna pay this. You're gonna write a check. You're gonna send the money to the IRS for this, and it's 15.3%. So this one can add up very quickly. What else? Well, income tax. That's the other big one, federal. At the federal level, you're gonna pay income tax. And then the third one maybe is state. If you live in a state that taxes income, personal income, then you're gonna have a third tax. Well, let's look real quick at how much these can add up to. We talked about self-employment, 15%. Federal income tax, anywhere from 0 to 37% at the high end. And then state income tax, again, this is a huge range depending on which state you live in, from 0 all the way up to 13%. I'll let you figure out which state's the 13%. So we've looked at the taxes and how much they could add up to be. What I really want you to take away from this today is an understanding about how much taxes is going to be withheld from your 1099. How much in taxes is your broker going to hold out of your checks when they pay you your commissions? Okay, let's look at a sample 1099 NEC. Whoa! Look at boxes 4 and 5. Do you see that? That's how much withholding is coming out of your commissions. 0. Nothing. Now, let's compare that to a sample W-2 form. You're probably familiar with one of these. Now, look at boxes 2, 4, 6, and 17. All of these are taxes that have been withheld from your pay. Plus, what's not even shown here is there's that other half of your Social Security and Medicare that your employer is paying without you even seeing it. So your broker is not paying these taxes for you, not withholding money from you or your pay and your commissions for these taxes. Who's going to pay them? You are. And this is what you have to plan for. This is what gets real estate agents in trouble, is they get all these great commissions, they get to the end of the year and they haven't set aside $1 for taxes, and the tax bill cometh, and now they're in bad shape. They don't have the taxes. They don't have the money to pay the taxes. So don't find yourself in that situation. That's why you're watching this video right now. Now, last section, let's talk about estimated taxes. So what are estimated taxes? Well, estimated taxes are kind of like self-withholding, where you're withholding your own money and you're sending it off to the IRS at certain intervals. There's 4 of them, but at certain intervals during the year. The primary reason, and there's a secondary, but the primary reason to make estimated payments is to avoid the underpayment penalty or the estimated tax penalty. The IRS wants its money during the year, and if you don't pay it and this it's a complicated calculation, but just for the purpose of this video, remember, we're not diving deep into tax code. Amen. Understand that the IRS wants their money during the year. The secondary reason, which is much more minor, but simply like a savings account, get the money into the tax system so you have your taxes paid. So when it gets to the end of the year, you're not facing penalties for failure to pay and interest on unpaid balances that can rack up quicker than you believe. So let's look at a sample of a 1040 ES form. This is the estimated tax form. Not very exciting. It's fairly straightforward. You can see it only takes up a third of the page, but that's what it looks like. Now, more often, what's happening nowadays is people are paying the IRS in general, but there's also their estimated taxes right online through the IRS. They have a couple different websites, but the one I like is called Direct Pay. And here's what that website looks like when you're setting it up and choosing to pay your estimated taxes this way. The great thing is that using this website avoids the need to file a form. The due dates for these estimated payments are as follows. You got April 15th, June 15th, September 15th, and January 15th. And again, you want to make these estimated payments in order to avoid the underpayment penalty and also to get the money in the system like a savings account so you have your taxes paid and you don't end up with a tax bill you can't pay coming April. Every state's a little bit different on how they handle estimated tax payments. Some require them, some don't. And when they require them and how much, the calculation is very state specific. So this is an area where I'm going to default and say, talk to your tax advisor for guidance for your specific state and your specific situation. And it's really the reality with estimated payments. This entire section is they're very specific to your situation because other things in your tax life could have a big effect on how much you need to make in estimated tax payments and if you need to make them at all. And there's other ways to get around estimated payments if you over withhold from another job, and there's all kinds of things to plan and strategize. For the purpose of the video, I just want you to have a basic understanding of what estimated payments are and why you should make them. Okay. There you have it, my friends, a complete overview of income taxes for real estate agents. If you have a question, shoot me a comment. Thanks for watching. Who's doing your taxes?